Housing starts, building permits and existing home sales numbers all out this week, and it looks like the housing market has plenty of momentum ahead of it. A new study by TransUnion finds up to 17 million new home buyers are expected to enter the housing market in the next 5 years. For more, I'm joined by Joe Melman, Vice President at TransUnion, where he leads the mortgage business. Good to see you here.
Good to see you.
This study was very interesting because it showed that it looks like the younger consumers are finally going to get in there and start buying houses.
That's right. So if you look at that 17 million, over half of them we're anticipating are going to be in that younger age bracket of 20 to 39-year-olds. So that's very encouraging.
So what is behind that, do you think? Because we've heard so much about student debt really burdening younger people and they're delaying their housing purchases. Is that less of an issue or is something changing in the market?
I think there's there's significant changes in the market. So if you look at where we are now, it's very different than when we were during the bubble and right after the bubble and during the recession. So at those times, it was much harder to get a mortgage. Income requirements were much higher and down payment requirements were much more limiting. And now you have the market opening up, and that disproportionately impacts in a positive way younger people and enabling them to get into the market.
And you find that Fannie Mae is using a process called trended data when it assesses clients. So explain what this trended data is and how it's being used in the underwriting process.
Absolutely. So this is near and dear to our heart. TransUnion was the first to release trended data back in 2013. And it's an incredibly powerful update to the traditional credit report. It has trended information over time. So you can see things like an individual's balances building or being shrunk over a period of time. And you can see new information like whether someone's paying off their credit cards in full each month or carrying a balance or just paying the minimum. And so those are some of the insights that Fannie Mae is using and that as others adopt trended data, they'll be using to underwrite loans.
So does it mean for a lot of clients that might have been left out of the process or discarded, let's say they had a balance of $5,000, what this data will show is, well, yeah, but it was $10,000 6 months ago, so it's more likely to go in their favor?
I think there's certainly the potential for that. I can't speak to what Fannie Mae specifically is doing, but there is, they have publicly announced that they are looking at things like a transactor versus revolver, so that brings more power to individual consumers where they can change their behavior to start paying off their debts in full each month and actually get credit for that and have it impact their ability to get a mortgage.
Obviously, mortgage rates are so low, and they've been low for a while. But if we start to see interest rate increases by the Fed, is it going to price some people out? Or do we simply go back up to 4% for a 30-year, and that's palatable for a lot of people?
Right. That's absolutely the key question. I don't think anyone has that answer exactly.
Right now.
That's right. But I do think, that while we are likely to see interest rates increase, I think all signals point to a gradual increase. And I think it certainly have some purchasing pressure on particularly first-time home buyers, but you have counteracting effects, particularly in the economy, things like underemployment being in a much better condition and wage growth finally starting to impact. So these are all things that can potentially counteract rising interest rates.
Joe, do you see any changes in the horizon? We talked about how collecting the data is different. In the actual mortgage products themselves, will we see people continue to move to the traditional 30-year mortgage, or do you expect to see some creativity in terms of terms?
Yeah, it's hard to say. If you go to an analogous or a sister product like in auto loans, you do see a lot of more creativity around the loan term. While that's taking place in auto, mortgage is obviously a different animal. I think there's the potential for that, but it's really hard to say how that's going to open up.
Joe Melman, it's been great chatting with you. Thanks for your time.
Thanks for having me.
I'm Rhonda Schaffler with The Street.